In this video, we'll trade crypto futures on Bybit. I'm going to show you exactly how to get set up trading these on this system, including how to use the unified trading account, because this is what Bybit uses now. Also, how to use the different types of margin, like isolated, cross, or portfolio, what these mean and the pros and cons of them and which one you should be using, how to enter, exit, and edit positions. I'm going to show you through this video, timestamps for all of that down in the description. Let's come to the derivatives trading platform on Bybit then. If you want a beginner's guide for Bybit, you want to know how to get set up and get fiat currency on and off, I'll leave a beginner's guide video down in the description. All of the resources I talk about in this video will be down there, and that shows you a step-by-step guide. We're going to get straight into trading derivatives then and exactly what this is. So we're going to go to derivatives, and then Bitcoin US dollar tether market, the one that most people will trade. Now, if you do want a trading bonus or a deposit bonus on Bybit, I'll leave a link to sign up if you haven't got an account yet. You can make a deposit, you get a big trading bonus up to about $30,000 depending on how much you deposit. So you can check the details via the link below. Once we're in the derivatives trading platform, we have some options on how we can trade with leverage or just trade generally on the derivatives platform. Now, when you're trading futures, this is very different to the spot market because what we're doing is putting some collateral into our trading account to fund our positions. When we trade futures, we're not buying and holding crypto. We are just taking trading positions based on the price. So where we enter and where we exit, that is either a profit or a loss for us. And the way that we fund losses is through the collateral that we place. Any losses will be taken out of that collateral. And if we make any wins, then the equity of our account is obviously going to go in an upwards direction as well. If we want to trade futures, we have to get some collateral and some value into our unified trading account. Now, unified trading account is something new on Bybit. They had a different system before, but if you're using Bybit now, you will be switched over to the unified trading account. And what is a unified trading account? Well, this lets you trade crypto futures, options, and margin in spot as well. Margin in spot is where you actually trade in the spot market, but you're taking margin, meaning you're borrowing dollars to take a trade and funding any losses with your collateral. Obviously, all futures do this as well. And if you trade options, you're doing that as well. So this is for trading derivatives, or if you're leveraging up crypto, or essentially, using collateral to fund a position with some borrowing of some sort. All of that goes into your unified trading account. And so you can very easily manage all of that margin and the collateral that you place when you're trading. If you want to trade in the spot market, you need to take your value and put it in the unified trading account, and then you can very easily just switch that out into your funding account. So if you're not trading with any assets, just switch them out into your funding account. They're just going to sit there. If you want to trade with something, you just switch it into your funding account, into your unified trading account. You can very easily switch between them in the platform that you're using. So if you're trading spot or derivatives, come down here to the bottom, you'll see deposit and transfer. So I'm just going to press transfer here. I'm going to transfer some USDT that I have from my funding account. So that's where my non-trading assets will be. And I'm going to put that over to the unified trading. So I'll press all, confirm. That goes over to my unified trading account. Now those assets are available for me to trade with. You should see that my margin or available balance has actually gone up by the $100 that I put in. So unified trading account, what does it let us actually do? It lets us use the value in that account as collateral to trade with. Now, if you want to trade in the spot market, then obviously that is exchanging money for assets. And so there's no margin there. You just use the US dollar tether and get crypto. If you're trading derivatives, then you can keep that US dollar tether or USDC if you want and use it as collateral to fund trades. So let me explain unified trading, because if we go down to the types of margin that we want to use, there's 3 different types of margin. When we trade futures, we are using collateral in our account to fund our trades. Now, most people will use either USDT or USDC because these are dollar stable coins, and it's a lot easier to have a dollar value to fund trades. However, with unified trading account, you can use other crypto assets as well. So let me go through this. I'll just show you right here the supported assets that you can use as collateral to fund your futures trades. If you go over to your assets and then just go to unified trading account, it's right here. And unified trading account lets us use certain assets to fund our trades. You can actually see this right here in unified trading. So if you come down, you'll see that dollar amounts are of course used for, you know, funding dollar trades. And as we come down, we have Bitcoin and ETH that we can use as collateral. If we scroll down, we can see a lot of other crypto assets as well. So you can see these, maybe you have some of these assets that you want to use as collateral to actually fund trades. Some assets are, some assets aren't, but you can toggle them on and off, right? So if you don't want to use a crypto asset as collateral and you don't want it tied up in trades or anything like that, just toggle it off and then the unified trading system won't use it. Mostly though, you're going to be using Bitcoin and ETH probably as collateral, and so that's in your unified trading account. Now, if you don't want to use them as collateral and you don't want them tied up in trades, just switch it over to your funding account and then they won't be part of your trading account. So they're the assets that we can use. You can look at them for yourself as well. Now we get to the different types of margin that we can use. There's 3 ways that you can actually use the value in your account to trade with. The first one is isolated margin. Now this is the one that I would recommend for most people. This is the one that most people trade with as well. When you're just taking a position, right? So you want to go long Bitcoin or you want to go short Bitcoin or whatever, most people will use isolated margin. What is isolated margin? This is where your position in a trade is funded with collateral for that trade. So if I want to go long Bitcoin, I put $1,000 into the account and I go long with $1,000, let's say, with isolated margin. That $1,000 is tied up for that position. If the position makes a profit, that's great. If the position makes a loss, my $1,000 is tied up there to fund that position. If the loss is big enough that my account is wiped out and I get liquidated, that $1,000 is tied up, that $1,000 gets drawn down, and eventually that $1,000 gets liquidated there. That is completely and totally separate from any other positions that I have. So if I also have an Ethereum position with $1,000 and that is in a profit, then that's just going to be completely isolated from the loss that I'm making with Bitcoin. So isolated is each and every position is funded individually and is completely isolated from profits or losses in other positions. That's the one I'd recommend for most people, so you can just segregate all of your trades. Now, the difference here with cross margin is that all of the value in your account is used to fund all of your trades. So maybe you have $2,000 in your account, you have the same Bitcoin and ETH position. Well, the loss that's happening on Bitcoin is taking away from the profits that you're making in the ETH trade, right? So you can, of course, just add more collateral into your account to keep your Bitcoin trade open. You can close the Bitcoin trade, so cross margin is really when you want to fund all trades together with margin in your account. Isolated may be a bit simpler for people to manage. Cross margin may be better if you're looking just simply to fund all trades with the value in your account. You're looking to use Bitcoin and ETH as value to fund trades, right? And so isolated margin, you really need to tie up the underlying asset. So if you have US dollar Tether or USDC, that funds the trades, and that's that. With cross margin, you can use different collateral to fund trades. So there is a difference here. So as you can see, single asset mode, you can trade futures with USDT or USDC. With cross margin, that's when you're using the value, the US dollar value of all your crypto to fund all of your trades, and profit and losses can take away from each other or add to each other. Portfolio margin is a little bit different. The difference here is that you can't use hedge mode. You can only use one-way mode. What is the difference there? One-way mode is when you go long a trading pair. So you have US dollar Tether and Bitcoin as a trading pair. You can go long $20,000, and then you can actually take a short position of $10,000 in the same trading pair, and that's known as a hedge because now you're net long $10,000. A $20,000 long, a $10,000 short to hedge, you're net long 10,000. So you can hedge, you can take both long and short in the same trade and the same trading pair. One-way mode is simply you can go long, you can close the long, but you can't take opposite positions that are running alongside. So portfolio margin also uses all your crypto assets to fund all of your trades. Now we'll look at trading with leverage on Bybit and some of the things to know before actually opening positions. And the main thing when trading with leverage is knowing where your liquidation price is. That's the main thing. It's kind of the only thing we need to be aware of, because how much leverage you're taking is not as relevant as where your liquidation price would be, which means when your account equity, the collateral you have in there is just totally wiped out because you've made a loss. As long as your liquidation price is away from your own stop loss price, kind of doesn't matter how much leverage that you take, as long as you're comfortable with the dollar amounts, and the losses and the percentage losses in comparison to your trading account. So if these terms are a little bit new to you, then I suggest the free videos I'll leave down in the description. I've got a day trading guide that's like a couple of hours long that just goes through these step by step. My crypto investor course has 300 videos, which is literally step by step by step, short 3 to 5 minute videos that go through all of these terms and everything. So I recommend that if you want a little bit better, structured course. Links everything and everything below. But for right now, what we want to find out is, where would a stop loss price be? Where would the liquidation price be? And then how much leverage we can take. Now, you don't have to trade with leverage when trading futures. So we're going to go up to leverage right here. You can just put this down to 0 or 1 times leverage. So you're not actually using any extra leverage in your trades. I would recommend that for most people, or for beginners at least. And I can't recommend taking a lot of leverage. That's up to the individual. But I'll show you how to mitigate or at least understand the risks. What is leverage? 5 times leverage. This means that if I have $100 in my account, I can open trades in the market that value $500. So how can I do that with $100? I'm able to take that $500 value and trade, because that $100 is there to fund potential losses on that trade. If a $500 trade, let's say I leverage up five times on this, if a $500 trade goes down by 20% in value, my collateral is completely wiped out. This is why trading on leverage is riskier, because a smaller percentage movement makes much bigger wins and much bigger losses, or at least faster. And so you just have to be aware of that leverage and how it can affect your positions. So it's not necessarily that we're taking more risk, because it really matters where our own stop loss price is. So let's go through that. I've got isolated margin in this case, which is 5 times leverage. And so that means I can make order value. Let's put 500 here. You can see that the order value in dollars, so I can click this. I'm just doing order value here because it's easier to show you, just confirm that. The order value in the market that I'm trading with is $500 USDT, but the cost to me is $100. That's where the 5x leverage comes in. So I'm opening a $500 position and putting down $100 to fund a potential 20% loss on that position. So that's how that works. Now, what we really need to do is work out at what price would we get liquidated at. So if we open a long position here at 26,453, where does the price have to fall for us to get liquidated? We can input our trade details into the order calculator right here in order to see where a potential liquidation would be. For some reason, you can't see the liquidation calculator on these USDT perpetual trading pairs. What you need to do is go over to inverse perpetual, choose the same asset pair that you're trading, so Bitcoin USD, and then you have this option here, liquidation price. I have no idea why it's not in here, USDT perpetuals. Liquidation price isn't there. So a little bit strange. I don't know if that's like an error or something with the trading system, but anyway, liquidation price, we want to go long. We're in isolated margin long. We're taking 5x leverage, and we want a $500 position like this. The entry price is just say the last price. So we're looking at a liquidation price around $22,000. So that's our liquidation price, where if we enter a position right now long, we'll get liquidated if the price falls to 22. So we're at 26 now, 22 is our liquidation price. So our stop loss price, that is a price that we determine we get out at and take a loss because the trade's moving against us. That has to be above 22,000. If it's below 22,000, we're taking too much leverage. If our technical analysis told us that 20,000 was the area to, take losses at, then 22,000 is just too much leverage for us. We're going to get, stopped out before our own stop loss price. So that's not good. So that's how we determine the liquidation price. And now we can determine our own stop loss price. Your own stop loss price is going to be set first via your technical analysis. So we do this first, and then we can work out how big our position can be and what our stop loss price will be, how much risk we want to take in the position. So the first thing is we need to figure out what our stop loss price would be. So I'm going to go out to the daily chart here, and then I'm just going to use some technical analysis. So as you can see, we have, or at least I have, a support band right here and a resistance band right here. Why support and resistance? Just gives me some trade levels. We can see that we got resistance, which turned into resistance again, which broke through, turned into support, and it seemed to have support here as well. So this price level is a support and resistance zone, and this price is around 24,800, call it 25,000. Right, so that would be a lower bound for any trade for me. Now, if I'm trading on a shorter time frame, maybe we can take this small area here as potential support and resistance as well, which would be, you know, around this level, right? So that can be maybe 2 levels you want to trade at. I don't know what your trading strategy would be. If you want some trading strategy videos, I'll link some down in the description for you. But we're going to say that this price level here for a long is our stop loss price, which would be 25,500, something like that. Right, so that would be our stop loss. So we know our stop loss now. So we now know the price level that we are going to get out of our trade at. So if we take a long position here, hoping for the price to come back up to maybe this trend line or this moving average, right? That would be our trade to the upside. And if it moves down here and a little bit below, we would get out because the trade is moving against us. I'm actually going to move this down a little bit because it probably needs it. So let's say 25,200. So we now know our stop loss price. Now what we can do is figure out exactly how much money we can put into this trade. So we're going to go over to an order size calculator. You can find these online. I'll link this one below as well. We're trading Bitcoin USD, and the opening price we know is the price we're going to open at, which is the market price, 26,467. We're also going to put our stop loss price in because we know that, because we've done our TA, 25,200, and then the account balance doesn't really matter. We can just make it a round number. We'll just put 1,000 in here. 2% is $20. So we know $20 is at risk, which is 2% of our account. And we can see the unit trade size now is 0.0158. That is how much you can trade in Bitcoin terms. So that's the size of your position. And we know that if we trade with that size, and if we get stopped out at this exact price level, we lose $20, which is 2% of our account. So that's the trade size we can trade with, 0.0158 BTC. Now what you can do is, if you want to trade with that size, you can go to order quantity Bitcoin, and then you can put 0.0158, something like that. So 0.015. So that would put your trade details in. Now, if you don't want to do that, you can see the value of the order is around $500 and the cost would be $80. You can see that right here. So we can also just switch the value, and I want to put in a value of like $300 or something like that, right? So you know that it's going to cost you $60 here. You've got $100 in your account, so there's no big issues. Now we can enter our trade, and it doesn't matter how big the trade is, right? It just matters the percentages that you're working with. So the order by quantity, if you have a quantity, you can put that in here. I'll just show you with an order by value. So $100 value, cost is $20 for me. Now what I can do is just double check here. So go over to the inverse and do the liquidation calculator, 5x leverage, $100 trade. Entry price is the last. I know the liquidation price is 22, so miles away from my own stop at 25.2. And then from here, what we can do is do a take profit and stop loss trigger down here, 25,200. I'm making a 23% loss on my trade if the price gets there. So that is not a price loss of 23%, right? If we're losing $1,000 on the trade, so you'd get in at 26,004, you'd get out at 25.2. That's not a 20% loss on the price, but it's a 24% loss for us in our trade because of how much the value is and how much margin we're using, and how much that real percentage loss would be versus what we're putting into the trade. So if we're happy with that, we can press confirm. This is a stop loss trigger that will be entered when you enter the trade. So I'm going to press confirm there. Now you can see what you can do. I'm just going to use market order right here to show you. So open that with a stop loss price at this level. If you want to go ahead and put a take profit price in at the time of trade, you can do that as well. You don't have to. So I'm just going to cancel. we're going to buy long. We're using $20 margin, as you can see the cost. So buy long is going to show you those details. You can press confirm. Then that order is right here for you. So now we have an open position. You can see on the chart, we have the open position here, which is in green. It might be red if you're losing. And then you have the stop loss price right down here that you can see. So now we have that open position long. We have our stop loss price down here, which is perfectly open for us. If it gets down here, we will trade out of the position. Our liquidation is way lower, so we don't have to worry about that. Right here, you can see the trade value, the order entry price, the mark price, which is the actual mark price of the contract. That is the official price that will be used to determine any liquidations that may occur, not the entry or the market price. This is the market price. This is irrelevant compared to the mark price of the contract. This is the official contract price that you need to look at. That will be used to determine any liquidations, because what can happen is the market price on the system can go up and down and might be an error. That's why the mark price, the official contract price, is the official price that's used for liquidations. We also have the liquidation price here. You can see it's actually a little bit below 21,300 because of some fees and extras involved. And then what we can do is edit all of this. So this is the amount of margin. You can see I've got $15 margin here. I'm going to open this. What you can do is add margin to the position. So you can actually decrease the leverage by adding some dollars into your account to decrease leverage, increase the margin that you have, and that reduces or moves away your liquidation price. If you're getting near to your liquidation price, you might want to do that. Just add some more dollars in to keep the trade going, or not, because you want a hard stop there. We can also see the unrealized P&L, so whatever that is. And then what we can do is enter or edit take profit and stop loss prices. So you can see that I put my my stop loss price in here at 25.2, so I'm going to edit that. You can either edit this around, you can see this, or you can, enter a take profit trigger up here as well. So we're just going to cancel that. You can also take some equity out of your position if you are making some profits. So what you can do here is close by market order. So you just, sell a certain percent at market. You can also enter limit orders here as well to close. So I'll just show you with a limit order, the closing price that you want to close at, you can choose. And then the amount that you close, you can choose. So if you want to close the whole entire order, choose 100%. If you want to reduce the order size and maybe take some profits out, you can close 50 or 25% of the order or 10% of the order here. And so what that does, you can choose the exact amount here as well. But you're closing part of the order, realizing some profits or some losses potentially out of the order, and just reducing the size of what is actually out in the market as an order. So you can do all of those things and edit everything. So I'm going to show you just closing the position here. We're going to close by market. We're going to close 100% of the order, press confirm, order completely closed, and you're out of the market again. I'll leave some much more detailed guides down in the description for free. The Crypto Investor course has trading and futures trading guides as well with many strategies. You can check the videos via the link below. Also, if you can't trade on Bybit, you can check out something like Apex Pro, which is essentially like an on-chain Bybit, which is where you trade on-chain. So you actually have your crypto assets in your own wallet and you can trade them like that. This is decentralized on-chain. You can keep your assets in your own wallet versus putting them on a centralized exchange. I'll link a tutorial below. It's very, very similar to Bybit and it's on-chain. I'll link Apex Exchange below as well. I'm James, this is MoneyZG. Cheers for watching and I'll see you in the next one.